After a long, amazing bull run, when the market finally takes a turn, it can feel, well, messy. It's confusing, it's uncomfortable, and all the rules that you thought you knew, they suddenly don't seem to apply anymore. Investors who felt like geniuses just months before are left scratching their heads, wondering what on earth went wrong. So let's talk about the mindset shift you need to not just survive these times, but to actually come out stronger on the other side. We're talking about the journey from being a permanent bull to becoming a market realist. And that quote from John W. Gardner really hits the nail on the head, doesn't it? When you are right in the middle of a huge market shift, having the right perspective is almost impossible. It just feels like pure chaos. And that is exactly why we need a better framework, a way to step back from the noise and find that perspective that is so, so crucial. So, what we're really talking about here is this journey from one mindset to another. On one side, you have the permanent bull. Now, this is the person who gets swept up in the media hype, who relies on software that promises the moon, and who basically just hopes the good times will last forever. But the market realist, well, they take a completely different approach. They dig into history, they think for themselves, and they understand that navigating the market isn't some exact science. It's more of an art, and that's the journey we're going on today. To become a realist, first you have to understand the beast you might be facing. So first up, let's dissect the anatomy of a bear. So what is a bear market, really? Well, simply put, it's just a depressed or declining market. And notice we're not just talking about stocks here. You can have a bear market in real estate and fine art and basically any asset that gets way overvalued and then comes back down to earth. This is a really critical point. It's a broad economic principle, not just some Wall Street thing. But here's the thing, not all bears are created equal. They actually come in different sizes. You've got your baby bears, those are the quick, sharp corrections that happen, but the bigger bull trend is still intact. Then you have the mama bears, which stick around longer and do a lot more damage. And finally, you have the papa bears. These are the multi-year monsters like the Great Depression that cause major economic pain. Knowing which kind of bear you're up against is absolutely key. In any bear market, you're going to hear this term a lot, short selling. It's really just the complete reverse of a normal trade. Instead of buying low and hoping to sell high, you borrow a stock. You sell it first at a high price, and then your goal is to buy it back later at a lower price, and you pocket the difference. It's a key tool, even if it's a little controversial, for any market realist. But wait a minute, isn't there something kind of wrong with short selling or, unpatriotic? That is a super common myth. The reality is, it's a perfectly legal strategy, the SEC allows it, and you're not actually betting against a company's success, you're betting against what other investors think that company is worth. And here's the part that sounds a little crazy. A healthy society needs people with money left over to provide capital for the next recovery. By buying back stock to cover their shorts, these sellers actually create buying pressure that can help cushion a market's fall. Now, if you want to be a realist, your single most important tool for gaining perspective is history. So let's dive in and see what lessons it has to teach us. If you just take a quick glance back at the 20th century, you see that bear markets aren't some rare black swan event. They are a regular, repeating part of the economic cycle. From the panic of 1907 all the way to the dot-com bust, these major downturns have happened, on average, every few years. Thinking that this time is different is probably the biggest and most expensive mistake a permanent bull can make. Now think about this number for a second. 35%. Over the course of the entire 20th century, the market spent a staggering 35% of its time in a bear phase. That's more than a third of the century. This isn't some rare hurricane. It's a reoccurring season that every single investor needs to learn how to prepare for. And this right here is why that simple mantra of just buy and hold forever can be so incredibly dangerous. I mean, sure, it works, if you can wait long enough. But after the 1929 crash, it took 26 years just to get back to where you started. After the 1966 peak, it was 16 years. A market realist gets that a passive hold and hope strategy can literally mean decades of lost time. Okay, so we know they happen. We know they can be devastating. So the next logical question is, how in the world can you spot one coming? All right, let's look at the classic warning signs. Now, no single one of these is a perfect crystal ball, but when you start seeing several of them flashing red all at once, well, it's a pretty good signal that the party might be winding down. These are the big tells. You start to see this widespread, almost euphoric confidence, even when the actual economic numbers are starting to look a little shaky. You see price-to-earnings ratios stretch to historic highs. You hear the media declaring a new era where the old rules just don't apply anymore. And you definitely see fads pop up, like the dot-com bubble, where people completely ignore business fundamentals because they've fallen in love with a good story. And on the flip side, the signs that a bear market is hitting bottom are pretty much the mirror image. The news is just universally terrible. The general public wants absolutely nothing to do with the stock market. Valuations are cheap, and there's a ton of cash sitting on the sidelines in brokerage accounts. That's latent buying power, just waiting for a reason to jump back in. Okay, now this next one is one of the biggest traps in a downturn. It's called a secondary reaction, but you might know it as a bear market rally. This is a sharp, fast, violent move upward that fools almost everyone into thinking the worst is over. People pile back in, thinking they've caught the exact bottom, only to get absolutely crushed when the main downtrend starts up again. Learning to spot these suckers rallies is one of the most important skills a realist can possibly develop. So let's put all these pieces together. How do we make that final shift in our thinking? How do we truly become a market realist? Ultimately, it really comes down to this distinction. The science approach is always looking for that magic formula, that one piece of software that can predict the future. The art approach, on the other hand, knows that no two market cycles are ever exactly the same. It takes judgment, intuition, and frankly, the courage to think against the crowd, to combine different lessons from history instead of just looking for an exact repeat. And this is the realist's true edge. It's the crucial insight. A realist isn't a permanent pessimist. They're actually the ultimate optimist. They understand that a bear market isn't the end of the world. In fact, it's the necessary process that cleans out all the junk from the system and creates the foundation for the next great bull market. It's an opportunity, not just a crisis. There's this famous and, kind of brutal quote that just says it all. The greatest opportunities are always found when fear is at its absolute peak. It takes the courage of a realist to step in and act when everyone else is panicking. So, we'll end with a question for you to think about. When you look at the markets, and more importantly, when you look at your own decision-making, which one are you? Are you the permanent bull, always just hoping the party will never end? Or are you the market realist, ready to adapt and navigate whatever season the market throws your way?